Welcome back to Freedom Finance with Lanny, guys. Thanks for rocking with me right now. And I'm just coming out of the Cavs loss to Boston here in Game 3. If you guys don't know, I'm from Cleveland, or I live in Cleveland area, and it's going to be a tough game coming up for Game 4. Try to even the series again. So let's make some noise, Cavs. But that's not why you guys are here. Today, really, again, going off the cusp here, I wanted to talk about a single ETF. A single ETF that might be better for those that are, trying to reach financial freedom sooner, trying to retire early, because that's what this channel partly is about, is not just helping your personal finance situation, but maybe shedding some light on what things you could do or things you can invest in to hopefully retire early. So this single ETF might be better than just buying the S&P 500 VOO. Maybe it's better than, buying SCHD or a VYM, guys. So if you're looking forward to it, stick around here for this video and grab your favorite beverage, your beer, your liquor, your wine, because you're Italian, baby. And let's dive in to a single ETF that could be best if you want to retire early. Let's dive in. All right, here we are. We're recording this, or I'm recording this here, Saturday, May 11th, pretty late, a little bit after, 11 o'clock here at night, guys. And, S&P 500 is up over 10% this year. It's great. Gotta love that as an investor. Nothing wrong with being up 10% if you own the S&P 500. If you're buying VOO, essentially, is, my preferred pick. Again, you guys know, I buy $60 every single day. I save a ton of money and make sure I can at least achieve that target every single day. But the S&P 500 is also getting slightly expensive, right? The price to earnings ratio on the S&P 500, according to, various sites such as Vanguard themselves, multiple.com, somewhere in the 26.5 to 27.5 on the PE for the S&P 500. Now, it's a great growth play because you're getting all of the tech and AI infused stocks in the S&P 500, hence why the S&P 500 is really up this year. You want to stay invested. You want to keep investing. I'm not going to change my strategy. I'm going to keep doing the $60 a day. But I'm debating about doing maybe a little bit more into another ETF that I buy. And I want to keep investing as much as I can with extra savings that I, have that I'm able to come up with every month. And, individual stocks are, not to say harder to come by, you can buy individual stocks, but finding undervaluation or on quality dividend growth stocks. Because again, I'm a dividend growth investor looking to retire early off of dividends. Been doing this for over 15 years. And, I've been burnt really recently, over the last probably 12 to 15 months, more so than I have in the 15 years over these last 15 months. Recently, the Leggett and Plot news, you guys probably caught that in the other video. And then 3M, they spun off their healthcare division, Solventum. So 3M's going to right-size their dividend. Solventum's not going to pay one for a couple of years as they strive to pay down debt. So some of these individual stocks, I'm going to see a slight step back in forward dividend income. Again, I own over 60 positions. So each small one, doesn't make that large of an impact, but I'm getting tired of some of these small setbacks. So as I may be gravitating away from individual dividend stocks, I'm going to keep buying them. You guys know I've been buying Starbucks, Johnson & Johnson stock this year. Broadstone Net Lease, there's a plethora of other stocks I do continue to buy when the price is right, and will continue to buy when the price is right. The problem is a lot of the high quality businesses prices haven't been right because of where the price to earnings ratios are right now for me. But I want to keep investing. I don't want to just keep it on the sidelines and hope and wait and wish for the market to come down. I'm not about timing the market, so I want to keep putting money into the market. And we all know I do a lot into VYM as well, anywhere between $300 myself to $450 myself every single week into VYM. And, that's great. Again, I'm getting current yield now, possibly sacrificing appreciation and growth later. Now, Vanguard's S&P 500, it's a great growth move, as I was saying. Historically up well over 10% over the last 10 years. I think it's somewhere around, if I take a peek down here at the chart, somewhere around, 10, 12% over the last 10 years, according to Vanguard's VOO. Now, the dividend yield on it is anywhere between 1.35 to 1.65%. And the average dividend growth rate, surprisingly, is fairly low on the S&P 500 VOO. And I'm seeing over the last 5 years on average, the Vanguard S&P 500 ETF, the dividend has been around 4.5 to 5.5% on the growth rate on the dividend. Let me know if you guys have seen something different. But again, you're really doing it for the appreciation play, right? You get a little bit of a dividend yield, you get a little bit of that dividend growth, but you want the market value to go up. Hence the 10 to 12% over the last 10 years. But you want more income now. But you also possibly want to protect growth as well, from appreciation or market value standpoint, as well as on the income side of things. So VYM, your dividend growth rate is going to be better than the S&P 500, but your appreciation is not going to be there. And again, that's where my other ETF that I buy every day, currently it's at $40 a day, which is the Vanguard Dividend Appreciation ETF, or VIG. And Vanguard has this ETF. It's got close to, I think, 100 billion in assets within the fund. And their goal is to buy a portfolio with about 340 stocks right now that have history of growing dividends. Great. Lines right with my vision and mission. Now, the dividend yield on it is higher than the S&P 500 or VOO by, 10 to 20 basis points. I think it's around 1.7 to 1.85% on the dividend yield. Now, the big benefit here is the dividend growth rate. You're looking at somewhere in the 8.5 to 9.5% range on the dividend growth. So remember, the S&P 500 VOO over the last 5 years has been about 4.5 to 5.5. Well, this is, about 8.5 to 9.5 on the growth rate on average on the dividend. Now, the appreciation, of course, to the name of the dang fund, is also there. So your market value increase play is there. Slightly behind VOO the last 10 years. I think they're around, 10%. At 10.89% has been their 10-year return in VIG. So slightly behind VOO, but again, much better than VYM. And really here, you get a better yield, better dividend growth rate, while maintaining a significant amount of that market value appreciation. And is this the best one? You know what I mean? Is this the best ETF? If you were starting out, could this have been the best ETF for you? You're going to get the growth. You're going to get some consistent yield, but you're also going to get income growth. And, just to kind of do a frame of reference, if the 8.5% dividend growth rate stands in 10 years, the 1.78% yield that it currently yields, in 10%, you're yielding 3.71%. with that 8.5% compound factor every single year. So just keep that in mind, that over time, the yield really starts to grow and explode here on VIG. And more than likely, the market value would continue to trend with it. So the goal here then is hey, do I start adding more? Do I go from $40 to $50 a day into VIG? That's something that I'm debating on doing right now, just to give my appreciation plus dividend growth a little bit more of a jolt. When you add in the dividend yield plus the dividend growth rate, call it 175 plus 85, you're at a 10.25 dividend compound factor, as I call it, because I'm reinvesting the dividends plus the dividend growth. So that's kind of a phrase that I've been coined to say over the last, 10 plus years. So that's something that's important to me. Or do I simply add maybe the extra $10 to VYM? I would love to hear you guys' feedback on that. So that's what I wanted to cover today, guys. Is VIG could be the sleeper ETF. It could be the underdog ETF for those really wanting to retire early, simply because you'll have more income, and the income will grow much faster than VOO, and it'll grow faster than VYM on both the dividend standpoint as well as the appreciation or the market value, if that matters to you. So let me know what you guys think. If you're young, or hey, maybe you're 20, 30 years into your career, maybe you're in your 40s or 50s, and you want to add some income, but income that grows faster to your portfolio, this VIG could be a solid option for you. But maybe, hey, if you're very young and you're just starting out as a beginner investor, someone who's looking to find out which ETF to buy, VIG might be the best option if you want to retire early and use that income to pay for your everyday expenses like this guy. So let me know what you guys think in the comments. Do you own VIG? What is your alternative favorite ETF to Vanguard's VOO? Let me know in those comments, guys. And again, if you haven't, definitely like the video, subscribe to this channel. Thanks for rocking with me. Let's go Cavs, and I'll catch you on the next one.